so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and Realtor.com does not think that we are headed into a housing market crash. Now, in a perfect world, Realtor.com wouldn't be so overly optimistic, and they would help us better understand the trajectory of the housing market, citing with caution over optimism. And we're seeing that from a lot of big companies like Zillow and Redfin and Opendoor as well. So a lot of these companies are overly optimistic. And I believe that's a result of, yes, I understand there's greed, but also I believe these companies were ill prepared for what was coming. I believe they were also rug pulled and flip-flopped. Now, as we go into 2022 and into 2023, I really want to point out how important it is to get our data from multiple data providers. Now, we're going to jump into that article titled, "The US May Already Be in Recession. Will the Housing Market Collapse Again?" Now, you guys remember, I'm not a financial advisor, even if I want to be. This is my personal YouTube channel. I'm working real hard to get you guys a video a day. When I can, 2 videos a day. So please, for my efforts, guys, like this video, comment below, and subscribe if you haven't already. Hit notifications so that you know as soon as I have a video that drops. But we're going to jump into this article right now. Now, I'm just going to try to read this article so that you guys can kind of determine on your own how you feel Realtor.com is doing as far as warning us as consumers about what's happening, or just overall giving us data to what is relevant as far as purchasing and selling homes. The article starts, "The economy is shrinking, inflation is soaring, and the stock market is losing value. Searches for 'Is the US officially in recession?' are now trending on Google. If the nation isn't already in recession, it might be well in one soon. And it's left those with PTSD from the Great Recession of the late aughts wondering if another downturn could sink the hot housing market as well. The last time around, housing was largely to blame for the most prolonged financial bloodbath in recent memory. When the bad mortgages imploded, the nation was left with scores of foreclosures, countless new homes sat empty, and millions of Americans suddenly found themselves financially underwater. Unemployment soared, businesses shuttered. Most Americans don't want to experience a repeat of those 18 months of misery. For me, it was 13 years. The housing market's rise over the past 2+ years with soaring prices, bidding wars, and an influx of investors has drawn plenty of parallels to that earlier ramp-up period. However, this time the housing market won't be the cause of any downturn and might even help nudge the nation out of one. So our housing market is essentially going to save us from recession or help nudge us out of recession. So do me a favor, y'all, comment below. Let me know if you agree with Realtor.com in that our housing market is going to save us from a recession. Personally, I don't think that, because of record unaffordability and runaway inflation being a high of 41 years. Because of those things, I don't agree with them. But either way, let's get back to this article right now. "Housing leads the economy," says Robert Dietz, chief economist of the National Association of Home Builders. "Housing is often the first sector to experience weakness during a recession, but it's often the first sector to rebound as well. Most real estate experts do not think the housing market is in a bubble or is in a threat of a sputtering economy. Despite home prices rising nationally by more than 31% in just 2 years. This time around, there are far more buyers in the market than there are homes available. A complete reversal of what happened in the 2000s. Bad mortgages have mostly been eradicated. Lenders have much tighter qualification for borrowers." So here's the thing. The bubble, which I'm referring to, excessive equity growth. The bubble that we have in 2022 is comparable to the last bubble, only it was made in half the time. And we have to say, why was it made? COVID. This housing market exists right now because of COVID and all of the stimulus and money printing and shutdowns and all of those types of things. Now, also, yes, today's lending standards, or specifically income verification are much, much stricter. And that's why these interest rate changes like this has dramatic impacts on purchasing power because of the strict guidelines. So instead of just ending it like, oh, it's so different. Yes, it's so different. Explain why it's different and then go from there. I'm explaining why it's different. And my conclusion is it's still a bubble. It's still massive excessive equity growth. Only this time, I'm a lot more worried because it was artificially created in half the time. But let's get back to this article right now. Now, I get it. This is a bit of a read, but you guys should listen to Realtor.com. And essentially what they're saying to everyone, and to me, I would hope Realtor.com would be, again, more cautious instead of overly optimistic, but let's see what they're saying. But that doesn't mean the economy is recession proof. Typically, 2 quarters in a row of negative U.S. gross domestic product, aka GDP, portends as economic downturn. GDP dropped 0.9% in the second quarter of the year, preceded by a 1.6 drop in the first quarter, according to the U.S. Commerce Department. However, unemployment is still very low at just 3.6% in June. It's actually 3.5% now, according to the U.S. Bureau of Labor Statistics. Despite more companies rolling out hiring freezes and laying off workers, there are plenty of others still jockeying for employees. If the nation was in recession, many more people would likely be out of a job, and businesses would be complaining that they can't find enough candidates to hire. Recessions tend to coincide with shrinking economies. We have seen some shrinking, says Realtor.com chief economist. However, she points out that it is very mild contraction. When the data is revised, which typically happens each quarter, the GDP might even be positive. We haven't seen job losses yet, which is why whether we're in recession is up for debate. Again, like our current administration, like the Federal Reserve, Realtor.com is also siding with them on the fact that we can't be in recession despite the technical 2 consecutive quarters of negative GDP spelling out that we are in recession, but they're saying we can't be in recession because of the super low unemployment rate, which it is super low. But what I am saying is that information is tainted, just like the foreclosure data is tainted, because of the massive trillions and trillions of dollars that was pumped into businesses and small businesses in the form of PPP. PPP was essentially free money. Some companies got hundreds of millions of dollars in free money. Okay, so think about that. So it should be super low. And that's why I'm saying, so we also have a labor market that's in a bubble that's also fixing to collapse because a lot of that money, that PPP money and EIDL money is gone. But let's get back to this article right now. So the article concludes, the housing shortage is just too severe as there are far more people looking for homes to buy and rent than there are homes available. The mortgage industry also did crack down on loans that balloon in size or were designed for homeowners to default on. There was no loans that were designed for homeowners to default on. But anyways, and only very qualified buyers with steady verified income can qualify for mortgages. That doesn't mean that a whole bunch of the foreclosures were not suppressed because of the ban, but let's keep going. Even if a downturn comes to pass, economists don't expect to see the widespread unemployment that was the hallmark of the Great Recession. They also expect it to be a relatively brief recession. That means there won't be scores of homeowners who can no longer pay their mortgages. Those who are struggling might choose to sell their homes, potentially even for a profit they can pocket, rather than lose them to foreclosures and short sales. Without a lot of cheap homes flooding the market, home prices should remain strong. I don't expect a ton of foreclosures, says Hallie. The housing market was very different during the Great Recession. That doesn't mean the market isn't undergoing seismic shifts in the meanwhile, as mortgage rates have steadily been climbing into the 5+ range. Many tapped out home buyers are taking a step back. Some can no longer qualify for a mortgage loan enough to buy the kind of home they're seeking. Others can't afford the higher rates and higher prices or don't want to buy at the peak of the market. And some are so worried about a recession that they're taking a wait and and see approach. The result is fewer homes are selling, bidding wars are dissipating, and offers over the asking price are dropping. Many sellers have been forced to slash their prices, and home inspections and contingencies are back and should never have left. It concludes, if the economy goes bust, mortgage rates are expected to fall again. That should bring buyers who remained employed back into the housing market. When home sales tick up, it will give the overall economy a boost that could help the nation claw its way out of recession. Now, I agree with them. When the Fed decides to pivot or flip flop, it's absolutely going to bring buyers back into the market, and that demand is going to take away supplies. But the thing is, you guys, the facts are so strong. The inflation is so strong. They really can't pivot too much despite the overwhelming amount of political pressure that is currently being put on the Federal Reserve. We have not record, but we have 41 high runaway inflation. That's a fact. No one's just making that up. They must do these things in the tightening in order to combat that, again, despite the political pressures. So I want to conclude with about 4 things that came to mind after reading this. Now, number 1, rates right now are still historically low. So rates are still historically low. Yet the entire housing market is shifting. That should tell you how strong it is. Now, number 2, the housing market bubble that we have right now is in size comparable to 2002 to 2007. But in half the time, that should spell out how big this bubble actually is. Now, number 3, this problem is from hyper demand. Even though we are low on inventory and we have the inventory problem, because I agree with millennials, nevertheless, the short-term issue was hyper demand. When we take hyper demand out of the housing market, prices cannot sustain because they were not built on fundamentals, right? Number 4, price drops are only going to continue. And I do not believe personally that the housing market is going to prevent us from going into a deep recession or a bad recession. Now, other than that, you guys, I appreciate you following along with me on this journey. If you're out there investing in real estate, you know I wish you luck, and I hope you win.